I'd ask a more pointed question because I'm not sure I have all the insights that you do. So be more direct.
I don't have, I'm not known for throwing out some softballs, but look, I think let me take a step back. I asked you a couple questions on the fourth quarter call about regulations in California and what was going on there. And I think on the earnings call, you sort of said, hey, look, nothing's going on from a reg perspective in California. It's just cost of capital. We're going to get out of this Pets Best business. We're going to allocate our capital differently. Yeah. And I think since that time, there were some things that came out from a regulation standpoint of, do you have to stop doing that deal, right, with Pets Best and stop the underwriting if that was the case? So was it regulation oriented or was it truly cost of capital? And that's sort of what I'm going down the road.
Got it. Thanks. That's easier for me to understand.
Okay.
My conversations with Synchrony, the owner of Pets Best, started several years earlier. It was all cost of capital based. We had term sheets and agreements on how we were going to do things. During that time, California was talking louder to all insurance companies, not just Trupanion, about the idea of being able to, if you're going to quote a customer online and you have multiple products that you need to quote them the cheapest product that you have. So that was designed for the auto insurance, but that regulation applied to all P&C companies. It was coincidental, but it had nothing to do with the conversations that we had on it. It was easier for us to be able to, because we were already in those conversations, to say to Pets that, in California you're going to have to find somebody different because we're not going to keep doing it in California. But it was not the cause, and the timeframes are completely different.
Okay, so just to best use the platform to maybe clear some stuff up, there wasn't a consent order which essentially stipulated that you no longer underwrite Pets Best plans as of March 1st or anything like that?
No. What happened was the regulators said you either have a choice of quoting multiple products. We said we choose not to do that. They said, how are you going to do that? We said we will not write Pets Best moving forward. But that was easy for us to do because we already had an agreement with Pets Best.
So then, maybe to go back to where I started, unwinding the Pets Best agreement per what you just mentioned, was that a cost of capital argument, or was that California coming to you and saying, hey, look, if you
cost of capital. Cost of capital. The Pets Best agreement that we had with them, which is like typical MGA agreement, when we first started underwriting, they were a small business, and we say this is how much we want as a margin, and they said great, but if we grow to this point, can we get a smaller margin? And if we grow even bigger, can we get a smaller one? So our margins were getting smaller on that business. At the same time, they were accelerating their growth after Synchrony bought them. They had fresh capital, added a distribution channel, so they were growing exponentially. When they grew exponentially, the amount of capital reserves that is required for our aggregate business, because there is a growth penalty on how much capital you need to be putting aside. If you grow faster than 20%, you put a higher percentage. If you grow 30%, it's a higher percentage. So at one time I was having margins getting squeezed from them because of our previous agreement, and at the same time I was having to outlay more capital, and it just financially didn't make sense. But those conversations started several years earlier, and they probably would have progressed faster if we hadn't taken an investment from Aflac, because that gave us some freedom and more time to deal with it. But it was multi-years, and the coincidence of the timing of it is just that. But we did tell the regulator, they said, are you going to show them all, or are you going to pick one? Every insurance company has to make that decision. We said, no, we're just going to have one. And by doing that, we will stop writing this other business. But it was already an agreement in place.
And I think, Darryl, one thing that comes to mind for me at the core is, you and I have talked over the years where you gave a lot of transparency to the industry. You sort of had a high-end plan. Maybe just lay out for the investors why you didn't want to show both those plans. And you guys couldn't explain the value of Trupanion, or even if you said, hey, here's Trupanion, here's Pets Best, you weren't able to convey the value where you felt like people were going to go with that more of a premium-based offering?
Yes and no. So when you have multiple products, you decrease your conversion rate.
They were just going to be the call center and helping convert to Pets Best was part of your concern?
Well, we've run in different jurisdictions with multiple products, and if you have people choose bronze, silver, gold, it's another decision, and conversion rate drops if you just show one product. So that is one of the primary factors for us doing it. The other one is, term life versus whole life. You familiar with that? The difference? How would you describe the difference?
I'll let you describe the difference, but you probably know a lot more since you live and breathe this every day.
Well, term life is sold that it's cheaper than whole life because it has a duration period and a stop and an end. But it's sold as it's a lot cheaper than whole life. Whole life is covered during your entire life and it builds capital up at the end. Whole life typically needs to be sold, and it's typically sold through agents or other areas. Term life is sold on TV commercials. Another example would be in the UK market. One of the leading companies there, back a couple decades ago, they had one product. They added a few other products because competitors were putting in lower priced products. And when the pet owners went there by brand recognition, they ended up buying the bronze plan. And the bronze plan had lower retention, lower lifetime value, and it hurt the overall brand. So what we didn't want to do was have brand confusion there. And we, in other markets, we sell multiple products. You can't find them on our same website.
You're talking about like a Firkin and a PH.
Yeah, and the call center doesn't say, oh, if you don't want this one, I have another one. It's, one lane of traffic.
This goes back to your Uber X and that we talked about earlier. Okay. A couple other just questions that come to mind. California and what they talked about in terms of, hey, you're going to have to disclose both of these plans to the pet owner. Why California, going on in any of the other states where they're moving ahead with a similar proposal?
I haven't heard it from many other states. California does a lot of things that are unique to California. It was a proposition that came out of the auto industry. California is a state where people are elected, and they brought it out for a good reason. So what was happening in the auto was a company might have multiple products under different brands, and depending on who the customer was, they were selecting to just show them a higher priced product, but the product had the same coverage. And so it was unfair to the consumer. But the way the regulatory body wrote it, it made it the assumption that all products that you're selling all are equal. And we don't think a whole life product is equal to a term life product.
Yeah, I guess what I'm just a little bit confused about is I've been with you since the IPO, and it was always we're vertically integrated. We're going to pay out 72 cents on the dollar. The other guys don't do that. They're not vertically integrated. They're paying out 55, 60 cents on the dollar. We've got a better value proposition. We're going to win. Here we go. And now you're telling me, even at your call center, you can't explain to the consumer why you're better paying out 72 cents on the dollar versus the guy paying out 55 cents on the dollar. And as a result, you've scratched this. Well, not in your opinion, but you may have scratched the agreement with Pets Best.
No.
Why not just pay out 60 cents?
Stop for a second.
Okay.
So very clearly, we ended our agreement with Pets Best the way that it was previously set up because we had decreasing margins and increasing capital needs. We are still partnered with them. We still have business coming in from them. We are still growing with them. They have a choice of sending their products to one of two places. The margin we now have with them has expanded and our growth rate is slowed, and now it actually makes economic sense for us to stay with them. In California, we said, You can only write it with the other guy. But that's their choice. They could, by the way, Pets Best they could sell just Trupanion's product there.
But
if they wanted
going back to like that gold and bronze plan that you alluded to, why the inability to convey that value, Darryl? And if it's so difficult to convey that value to the pet owner, why not pay 67 cents on the dollar, 62 cents on the dollar, sort of a better margin proposition for the company, for Trupanion? Are you having a hard time explaining why 72 cents is superior to that Pets Best plan? You yourself said you're worried about losing conversion. You're losing conversion because of your inability to explain why your plan is superior. So, why are you having that challenge if 71, 72 cents is so much better than 55 or 60 cents?
You're confusing two topics. This is a fun one today. I like it, you're coming at me. So, you can have, let's go to Uber, for example. And I've used this example before. Mm-hmm. The experience we have with Uber Black that everybody got accustomed to with Uber, where somebody opened the door, there was a bottle of water, the car was clean, and you never needed to make a tip, was how Uber's brand expanded. When somebody then introduces Uber to them and they're picked up by a teenager on the way back from high school and has McDonald's wrappers in the back, and they're expected to tip and they don't open the door, you're degrading potential. And by the way, I'm not picking on Uber. I'm just saying you've lost what differentiated the brand to start with. In markets where penetration rate has increased, the people who tried to do that, it hurt their business. They lost their brand loyalty by doing it. So we don't want to have a lesser coverage product, even at the same value proposition, to confuse a consumer. So value proposition is one. Do you pay out 50 cents on the dollar, 60 cents, 70 cents? How much you cover and what you do you have 24 hours support, 7 days a week? Are you able to pay the hospitals directly? Do you have unlimited coverage? Do you have whole life type pricing philosophy? All of those things are incrementally different, and we did not want to confuse our brand, which we've been building for 20-something years. He introduced us, we're now the largest, we're the biggest, and I think our brand has resonated. We have been testing low and medium coverage product in some markets in completely different distribution channels. And we have other products that are sold through other distribution channels that are designed for them. Okay. But our product veterinarians are a key part of our ecosystem. And we want the veterinarians to have the confidence to be able to say Trupanion has the broadest coverage and the best value proposition.
And not anything to damage.
And not anything to damage that. It's not any more complicated.
I have a question. Well, first of all, I give you a lot of credit for the company you built. It's very impressive. But the problem I have, and I think the reason you can't really get a clear answer, is that you're just a chronic liar to both Wall Street, to your holders, and to your customers. Because if in fact, this was so planned with Pets Best in California, how come they don't have a new underwriter?
They do.
They didn't. Who is it? Who's their new underwriter? And when this happened, how come you didn't put out an 8K and say Pets Best is gone? Instead, on a conference call, you said we talked about it in the third quarter. So here's your third quarter transcript. And I'll give you $1,000 right here if you can show me where you said it. So it's time, Darryl, that you finally come clean and tell people the truth, right? Because I'm highly confident the SEC, after your 3 employees got fired and you paid them $3 million to shut up, along with his other mishmash you preach to people, I'm highly confident the security regulators are going to come for you. And it's just time you finally come clean and tell the truth. Because I'm just sick of listening to you, because you rip people off. The state of California is not going to give you a price increase. And it's just come clean and tell the truth for once. Please.
What was the question?
Come clean. I mean,
Complain about what?
how about come clean about California pricing? There was no statement in Q3 about Pets Best leaving. How come you didn't tell investors at the time of the Pets Best issue what was going on? You still can't explain exactly what went on. Talk about
What part can you? What part would you like me to re-explain to you?
I'd like you to re-explain how come when this happened, you didn't
What
get
happened?
the Pets Best stipulation order in the state of California.
I think just to try to mediate a little bit here, I think there's, sort of, as I like, just to try to make this as constructive as possible. There was a lot of confusion about what went down between, we were all looking at consent orders that were out there from a regulation standpoint saying this had to stop on March 1st. And then on conference calls, you sort of saying it was a proactive decision from the company to go ahead and move away. And I think just from an investor standpoint, and obviously I fielded a lot of questions, there was a hard time reconciling those and sort of saying with conviction, this is what played out. Was it regulatory driven, or was it a conscious decision by management to say, cost of capital has gone higher, we have to move in a different direction? And those are some of the questions that I continue to get. And that's sort of why I led with it. And
How was my answer?
I think I'm still a little confused, quite honestly, but we'll plow forward.
Well, we can dig in more. What are you confused about?
I think I'm still a little uneasy as to what was the driving force, and if it was the consent order, if it was management making that determination. Look, I think just
So, dig in more. So, going back until 2019, and then secondary meetings in 2020, and then follow-up meetings in 2021, we were in negotiations with the parent company of Synchrony, including a direct conversation with me and their CEO to say that the arrangement that we have is not working and that we need to come to a solution. You've been a good partner for us. We want to work in a way that's not going to leave you in a lurch. Okay. We worked through that solution. It took longer than we were anticipating. The time pressure got put away when we got the infusion of cash from Pets Best. And we executed it as quickly as we were able to. At the time that we were executing it, the California was saying, make a pick on what you want to do.
Yep.
We said we want to pick on just having one company. They said, okay, well then you have to agree that you're not going to do the other one. We said, no problem.
Okay, fair enough. Let's move forward. I just have some other questions. Balance sheet and cash at the parent. I still get questions that, on the surface, the balance sheet looks very solid, $253 million in cash at the end of the first quarter. But I think a lot of that is what sometimes people refer to as trapped cash, and it's cash at the parent. And in your 10Ks and the filings, you get a better view of cash at the parent. So I believe 253 is the headline number, but at the end of 2022, it looks like cash at the parent was 35 million, of which roughly 19 million was restricted, and free cash flow was negative in 1Q, and I have free cash flow remaining negative for the balance of the year. So you talked about the investment or the infusion that you got from Aflac. Some of my numbers around true cash at the parent, are those largely accurate? And then if free cash flow is negative for the rest of the year, how do you address some of what seems like some funding concerns as we work our way throughout 2023?
How negative for the balance of the year?
I'm sorry?
How negative for the balance of the year?
I know I've got you guys burning. If you only have $35 million of cash at the parent, then maybe I have you burning $3 to $4 million for the next handful of quarters. But what would be the thought of cash at the parent and how you would address that going forward?
Yeah. So the way that we've operated the company for years is we look at our adjusted operating income, which is the discretionary cash or profit we make from our existing clients before we reinvest in growth. So that's pre-tax dollars. It's above the income line on a GAAP income statement. So you're not paying tax on that, and we're reinvesting that, acquiring one pet at a time. If we have no CapEx and development expense, and we are spending the amount of that adjusted operating income, then you're basically running at cash flow break even. So in 2014, when we went public, we were about $100 million of revenue. We were cash flow negative that year. And by the way, this is all laid out in my 2022 shareholder letter. Tells us net cash inflows and outflows and which years we've done that. In 2000 and I believe 15, 16, 17, 18, and 19, when we had much smaller adjusted operating income than we're projecting this year, we were cash flow positive. We have been spending money on CapEx. So we bought a software company with some of the proceeds from Aflac, trying to build out our next gen software platform to support multiple policies in multiple countries and multiple distribution channels. And that has gone over budget. I write about it in my shareholder letter. It's about a year over, and we spent about $30 million than we expected. So that's been going in CapEx. I would say that we are 8 months pregnant on that one.
Okay.
So we've got a little ways to travel before that gets kind of shipped and out the door. Our development expense has been dropping. That was planned expense, expanding into different geographical areas, primarily into Europe. But once those places have gone live, and they are now live, they go out of development and into our PAC spend. So our cash flow is really something we can control because we can control at the rate of growth that we want to.
Okay.
Now with margin compression, which we've had, we've seen a 900 basis point increase in veterinary inflation in under 11 months. So the fastest rate of vet inflation that we've seen in our time. I've been doing this 25 years. And if I go back with the AVMA and other places, it's the fastest it's gone up in over 50 years. We have reduced margin compression, which means our allowable total dollars we can spend on PAC at a given time while being cash flow positive is going to be smaller than it otherwise would be. It also means that the pets we are acquiring, because they have a smaller margin than our target, if we don't reduce our PAC spend, our payback period of time will be longer. So we've reduced our pet acquisition spend on a per pet basis. And you saw that starting in Q3, Q4, and then Q1.
But even if you sort of, let's just say, go from a cash burn to flat, and think about the insurance industry or the capital requirements, right? So you guys have had a lot of success signing up gross ads or getting new policy holders. So even if you sort of say, hey, look, these initiatives are going to get us from burning cash to cash flow neutral, you're going to write many policies along the way, which is going to, you get the capital requirements that accompany that. So is the cash at the parent sufficient to fund the business, or should we think about, potential some other sources of funds as we exit 23 into 2024? Because you're going to be bringing on additional policies.
Yeah, it depends on the growth, the aggregate growth rate. So one of the reasons that going back to 2019 and 20, we talked to Synchrony, is because they were adding an incremental growth rate that meant the percentage of revenue that we had to hold aside got larger. With Pets Best still adding revenue but at a slower rate, the amount of capital that we have today without adding any additional capital this year would be sufficient to get us through to middle of next year. So we are right now overcapitalized compared to our capital requirements. So the ability to have to incrementally fund has been reduced. And that was, I'll repeat it, the primary reason that we drove the difference with Pets Best. The other reason was their margin was getting smaller and smaller as they became bigger. So we had margin compression because of the way we set up our original contract with them. And it wasn't economically penciling.
Cost of capital went up along the way.
Yeah, the amount of capital that was having to stay.
Can you get into why you fired the 3 executives and why you need to pay them $3 million if you fired them for Paws? And 2, I've never seen in 40 years of this business someone redact the terms of their credit agreement. Can you unredact the terms and just make that public so we can all see what your credit agreement is? And finally, how about the price increase in the state of California? Do you think you're gonna get the price increase, or do you think they're gonna hold the line? Because I think you're up 288% in 7 years in California, which seems a little high for me.
First question was when we let some people go at the company, why did we do it and why did we pay them severance?
Yeah.
So for anybody who has read our shareholder letters, the way that we do stock comp is in the event that we've calculated our intrinsic value year after year has grown greater than 10%, and there's this escalating factor, then a percentage of that increase is held out for a performance pool, and we share that with the employees. It is shared to them with a 4-year vest, but it is based on the performance of their prior year. What we did was accelerate that stock for those people because we felt that they had already earned it when we gave it to them. And we had already taken the full dilution on how we disclose everything in our shareholder letters. We thought it was the right thing to do.
How about the credit agreement in California?
I'm not sure what you're referring to in the credit agreement in California.
All the terms in your credit agreement are redacted, so no one can figure out where your covenants are, if you trip covenants, where the squeaky points are. Because at the end of the day, you're an insurance company, and you need to have, you're not a SaaS company like you claim. You're an insurance company, and you need to keep capital at the level so you can pay claims. So most people who want to analyze your company need to know the terms of the credit agreement, where your covenants are. Anyone who has debt, the covenant should be available to your shareholders. But when I look at your credit,
No, but you're saying credit in California, so I'm lost on that.
I'm interested in the price where you're trying to get a 28% price increase in California. That's one question. The second question is on your credit agreement, where the terms of your agreement, including your covenants, are redacted. No one knows those other than you and the bank. And in most companies, those are made public because financially, in my opinion, you're up against it. So I'd like to know how up against it you really are.
Anything on the credit agreement, or else we can hit up some other.
We have no risk of faulting on any covenant.
We just got 1 minute left. So I'm just going to try to hit on something really quick. Obviously, you say you don't want to dictate the cost of care. You're not doing that. You're predicting it. So I just want to go back to one of your last comments. You said that in April you didn't have any negative surprises, which was good to hear in terms of the cost of care. Just sometimes you give us updates even intra-quarter. What about May? Do you feel like maybe big picture view that the price increases that you put into place, of course, are not going to bring back the MLR to 71% overnight, but have there been any incremental negative surprises, or are you confident that some of the price increases you've put in place, we can get back to the stated goals of 71 exiting 23 into 24 with what you're seeing from an inflationary standpoint?
So what we have, our working assumption is that in 23, 24, and 25, that we expect veterinary inflation to be 15% a year.
23, 24, and 25.
Yeah. And we increased that at the end of Q1 after seeing, we were surprised. You said we're supposed to predict the cost. We predicted in 2023 veterinary inflation would go up 12%. That's what we were expecting going into the year, and it went to 15. We then looked at that information and we said, we expect it will continue to go up at 15. And by the way, in 2022, typically vet inflation goes up quite a bit in January. And then it's relatively flat for the year. It's not totally flat because 10% of veterinarians do a mid-year increase, but it's relatively flat. In 2022, we saw vet inflation go from 600 basis points to 800 to 10 to 12. And we saw, when we were predicting 23 and doing our rate filings, we had seen it go from 8 to 10, and we thought 12 was going to be conservative. We got hit with 15. We were negatively surprised. Our working assumption today is 15, and we're feeling confident with the 15 from what we've seen today.
Okay, so to your point, no negative surprises in April, and arguably no negative surprises in May, and so that revision to 15 you feel continues to be in the right place today?
Yeah.
Okay. Guys, we're running over. We're going to have to conclude right there. Dal, I appreciate you coming and answering some tough questions. Thanks.